Are cost segregation studies still worth it in 2024? In this video, I will explain cost segregation and lay out the exact blueprint on how every type of investment property owner can use real estate paper losses to offset various types of income. You may believe that you've heard this before, but trust me, you haven't. At least not in the way that I will be presenting the information. It's a good 25-minute next level comprehensive guide, all found in one place. If you have found your way to this video, then good for you, because this is the only video you're ever going to need on the subject. I'm not going to leave you with more questions and answers, and I'm not going to deliver info in a catchy way to try and sell you on a dream. My name is Carlos Melendez, and I'm a tax preparer authorized by the IRS to represent taxpayers in all 50 states. But my passion is consulting and hacking the tax code to pay as little tax as legally required. The goal after watching this video is for you to have acquired the knowledge to implement advanced tax strategies to offset various types of income, or to at least know what is and what is impossible. Without further ado, let's get into it. Let's begin with a brief rundown of the relationship between cost segregation and depreciation. There's no voodoo behind this. A cost segregation study merely assists a taxpayer in properly depreciating investment or business property. Because remember, depreciation is mandatory, whether you chose to depreciate your property or not in any tax year. It all gets fixed upon disposition of the depreciable asset with allowable depreciation. That's it. And there's a whole publication devoted to just this, which is IRS Publication 946, How to Depreciate Property. Granted, it's pretty long and a bit confusing, but that's why I'm here. So, cost segregation is actually expected and standard, and because depreciation is mandatory, you should segregate and depreciate your property correctly. So 99% of you are doing your taxes incorrectly. If you have a rental property and peak at your 4562 and only see building depreciation, which is 1250 real property, you've made a massive mistake. An investment property is broken down into separate components containing the actual building, which is 1250 real property, and 1245 property that'll have different useful life and recovery periods. 1245 property is eligible for bonus depreciation and in many instances 100% Section 179 expensing as well. We will get to this in detail momentarily. You may be familiar with a building class life of 27.5 or 39 years, but do appliances, carpet, and furniture have a useful life of 39 years? I don't think so, and neither does the IRS. It's actually 5-year property. The IRS also states that fences are 15-year property, and that certain electrical and plumbing components are either 5, 10, or 15-year property. If you own non-residential real property, then roofs, HVAC equipment, fire protection, alarm, and security systems also have much shorter useful lives. So even if you don't want to accelerate your depreciation to create a huge front-loaded expense, it still doesn't explain why you are depreciating this 5, 7, 10, and 15-year property incorrectly to either 27.5 or 39 years? Well, the answer is simple. Your CPA, tax preparer, advisor, and in many instances, tax attorneys suck. They're incompetent and either don't comprehend tax law or just don't care. So let me repeat this again. Your trusted professionals suck. They have weakened you and allowed our government, which just wastes money overseas, to hold on to your hard-earned money for decades more than what they were entitled to. It's not the IRS's fault. They gave us the blueprint, the exact playbook in Publication 946. It's not their fault. The tax preparers are awful and incompetent. It really isn't. So now that we have this background information, and I told you you haven't heard this information presented in this comprehensive way before, we can get into what a cost segregation study actually is. Stay with me. So, A cost segregation study is a report purchased from a company that employs various licensed professionals like engineers, architects, CPAs, and enrolled agents. The purpose of the report is to segregate your investment property into the building, 1250 property, and 1245 property that has a much shorter depreciable life. These 1245 depreciable components are eligible for much more favorable depreciation treatment than 1250 real property, which only has the option to recover its useful life evenly over the course of 27 and a half or 39 years. If your property has a market value of $500,000 or less, you can purchase a conservative online report for around $400 to $500. If not, you will have to go with a full report that ranges from $2,500 to $3,500 for most cases, and up from there in line with the value, complexity, size, and nature of the property in question. The full reports include an engineer visiting your property and also provide audit support. The full reports usually prepare the 3115 for you if needed, which is an IRS form that fixes depreciation, and they stand by all forms and reports with their company name and the associated professionals they employ. The conservative online reports usually are able to segregate about 10 to 12% of property value into 1245 categories, and the more expensive full reports segregate anywhere from 15 to 24% of property value. For simplicity, let's just use 20% as the figure for full aggressive reports. So remember, depreciation is part of an investment property's expense. So on a $500,000 home, if Section 179 is applicable, an investor will receive an $100,000 deduction. And if only bonus depreciation is applicable in 2024, 60% of that figure, so a $60,000 deduction, will be created. The deductibility and offsetting of other income with this deduction is another matter entirely, which I will cover next. Now that we have established that a larger depreciation expense and/or an accelerated paper loss can be created, it becomes your responsibility to determine if your particular situation will even benefit from it, how it fits into the relationship between income and expenses, the nature of the paper loss, what types of income it can offset, and the future repercussions to offsetting various types of income. I will address these topics momentarily in detail as they pertain to passive activity income and non-passive activity income. I will use terms like Section 179, bonus depreciation, real estate professional, Schedule E, Schedule C, recapture, activity rising to the level of a trade or business, material participation, active participation, long-term tenant, short-term tenant, passive activity loss rule, excess business loss limitation, and more. Hang tight. Your exact situation will be covered because I will cover them all. Let's continue on with passive activity income and the definition of a regular investor, as I will use this term a lot as the video progresses. Most of you are regular investors. You have a business or a job, or don't have a business or a job, but you own investment property with long-term tenants under standard 1 or 2 year leases, or maybe you have month-to-month tenants. You may be casually involved in the short-term rental business with Airbnb or other sites, or do seasonal vacation rentals or midterm rentals with or without property managers, and your properties are either local or out of state. You work on the properties and the business somewhat, but it doesn't consume you, and you don't really monitor the average guest stay duration. You either have one or a handful of single or multifamily homes. You are not a real estate professional, and your rental activity has not risen to the level of a trader business. You use Schedule E to report your rent and expenses, and you don't pay self-employment taxes on your rental activity. You depreciate only the building portion of your investment property, which is 1250 real property, over 27 and a half or 39 years. You are bound by the passive activity loss rule as long as you actively participate, and may be able to offset a maximum of $25,000 of any earned non-passive income, like from your job or a business. If that's you, which is probably most of you, then there's some hope. I got you covered. Stay with me. So, regular investor net income is the most prevalent type of passive activity income. But if we are to assess whether or not a front-loaded depreciation expense that creates a loss will help us, we need to figure out what kind of income streams can offset each other in the passive activity space. There are two other forms of passive activity income that have a harmonious relationship where the gains of one offset the loss of another and vice versa. The first is being a limited partner in an activity and receiving a netted out K1. This can happen if you are a silent limited partner in a business or if you invest in real estate syndications as a limited partner. The second is the sale of an investment property of the previously defined regular investor. Now remember, the regular investor isn't eligible for 100% Section 179 expensing, as Section 179 only applies to a trader business or investment activity that rises to the level of a trader business. We will get into this in a moment. The regular investor is only eligible for bonus depreciation, so the maximum deduction that an aggressive full report can grant you on the previously discussed $500,000 home in 2024 is $60,000. If this $60,000 depreciation expense creates a loss off the building it pertains to, this paper loss can offset the net gain of any other regular building, the sale of a regular building, or the netted out profit of a K1 from a limited activity. So if you aren't willing to change the way you operate, this is all that you will be eligible for. If you don't have any of this, then the loss can be carried over to future tax years and only offset the same types of income. But if you are willing to adjust the nature of one or more of your properties or purchase a new one and run it differently, then there's some hope later on in this video when I discuss pulling off the short-term rental loophole correctly. It's a loophole because it will be patched by Congress eventually, but not yet because they are slow and there's lots of red tape. Now, let's move on to non-passive activity income. Non-passive activity income is any earned income from a job, business, or an activity that rises to the level of a trader business. All these types of income have a harmonious relationship where the gains of one offset the loss of another and vice versa. In addition, a non-passive loss can also offset long and short-term capital gains. So as you can see, it's pretty powerful to create one. In the real estate space involving renting to long-term tenants, the non-passive activity that rises to the level of a trader business falls into two categories. The first is reporting your gross rents and expenses on Schedule C instead of the previously mentioned Schedule E that the regular investor uses. In this scenario, the business owner is subject to self-employment taxes and treated like any other Schedule C business. An example of this would be an apartment complex owner. All of the tenants can be long-term, but this is still a business like any other, as you may have a management office, a superintendent, landscapers, contractors, and other service people that you employ to provide significant services to the tenants. The second is if you are a real estate professional. I'm not going to get into the qualifications needed. You can just search it up. But in essence, if you are one, you know it. Basically, you either are one or you're not. So your primary activity and career and your principal way of making money is through real estate. You work on properties yourself potentially and are heavily involved day in and day out on a regular and continuous basis on the needs and demands of the business. This scenario is the best of both worlds, as you have all the advantages and deductions that a business owner has without paying self-employment taxes, and you register your rental activities on Schedule E just like the passive activity income investor would. Now that we got that out of the way, we can move on to the juicy stuff, the short-term rental loophole. This is the area of tax law that the scammers and criminals latch onto to defraud you and to defraud the IRS. There's really no other way to say it. But I will add that if you do it correctly, you definitely can pull it off safely and legally, receive huge tax savings, but you have to understand to the letter of the law what is going on here. I will do my best to explain it to you so that you can make a truly informed decision if this is right for you and your particular situation. The reason why it's so tricky is because there are things like intent, profit motive, depreciation recapture, excess business loss, overly aggressive cost segregation studies, 1031 exchange complications, and the expectation that depreciation will last at least 1 year. These principles rear their ugly head when you follow the scammer's advice. They don't talk about any of this stuff, and honestly, without understanding all of it, you have nothing and are on borrowed time for a financial implosion. So, what exactly is the short-term rental loophole? In essence, it's a way to convert semi-passive activity income to non-passive activity income, bringing us the last of the non-passive activity income sources and bringing with it all the tax benefits that are bestowed upon the real estate professional with a much smaller amount of material participation required, and also taking out the need for the activity to be the principal way that the taxpayer earns money. It's indeed a pretty ridiculous hack and will be patched by Congress soon. After watching this video, pausing and skipping back multiple times, you will have the tools to do it correctly and legally before it's patched. The exact rules are the following: spending at least 100 hours and more than anyone else on the activity, and making sure your average guest stay is 7 days or less. Are you getting a feel yet why the scammers love this so much? Let's continue on. All of the non-passive activity income scenarios just discussed can use 100% Section 179 expensing and have that loss offset various other types of earned income, like any job, any business, other better performing short-term rentals that you were running under the guidelines of the loophole, and long and short-term capital gains from selling any property or security. So with the loophole, and going back to that $500,000 home previously discussed, you would avoid self-employment taxes and create an $100K paper loss that can offset $100K of net rental, $100K of net business income, $100K of W-2 wage income, and $100K of long and short-term capital gains on any property or security. But when something is too good to be true, it usually is. So with that being said, how do we actually pull it off and avoid negative future repercussions? Before answering this question, I need to talk a little bit about depreciation recapture. So do you remember the 3 non-passive activity income scenarios? Well, I'll remind you. They are real estate professional, apartment complex owner, and short-term rental loophole. When one of these does the study and gets the 20% accelerated into year 1 with Section 179, they have an $100,000 deduction that lowers any non-passive income or short and long-term capital gains by that amount. Unlike bonus depreciation, Section 179 also lowers taxable income on the state level as well. So any investor in a high-tax state like California, New York, New Jersey, Minnesota, Hawaii, Connecticut, Illinois, Vermont, etc., has an extra incentive to attempt to use Section 179. But there's a catch. Isn't there always a catch? Here is where recapture comes in. Section 179 has recapture and bonus depreciation doesn't when business use falls below 50%. And business use in this example pertains to being in the short-term rental business and following the rules of the loophole, spending at least 100 hours and more than anyone else on the activity, and making sure your average guest stay is 7 days or less. If you falter at any time on the rules, you are getting a full, not partial, but full recapture of almost all the deduction the IRS gave you in the previous tax year. And even worse, since the cost segregation study created 1245 property, the recapture rate isn't capped at 25% like 1250 real property dispositions. You are being taxed as ordinary income at your marginal tax rate, most likely ensuring that in the current recapture tax year, you will have the highest blended rate and pay the most tax on the state and federal level as possible, wiping out way more than the benefit you received in the prior year. Bonus depreciation is much safer because there is no recapture on no longer being in the short-term rental business. But it's also much less of a benefit. It doesn't provide a state benefit, and it's capped at 60% for 2024. It does lower your basis in the property, though. With this information at hand, we can move on to actually pulling it off. Remember a couple of minutes ago when I spoke of intent, profit motive, and a few of the other pitfalls with this strategy? Well, avoid the pitfalls. If you are not willing to commit long-term to the short-term rental business, manage the property yourself, and make sure you have what it takes to dynamically monitor your average guest stay duration, then I would strongly advise against using Section 179. If at any point you get a property manager, you're done. You're not following the rules. You even need to be careful on out-of-state properties because it's really not believable that you don't have a property manager for an out-of-state Airbnb. I mean, I guess it's possible, but I just don't know. If you are going to give it a shot and see what happens, I would strongly recommend using bonus depreciation instead. Give it a real shot. Set it up nicely, take good pictures, manage the business yourself, use multiple platforms to market it, coordinate the cleaning and repairs, and you should meet material participation and not have any issues. If you place the asset into service in November and meet material participation, and then let's say we find ourselves in February or March of the following tax year, and you are bleeding money or don't like the business, or are tired of dealing with Airbnb, or had bad guests, or just want to quit because it's not what you expected, you should be fine. Dispose of the asset on your taxes in March, with the disposition date being the last day you had the property as a short-term rental, and assign a new placed into service date the day your property became available to mid or long-term tenants. That's it. You should be fine. Even though depreciation is expected to last 1 year, and it only lasted 4 months, you'll be okay due to a loss of revenue over what a long-term tenant would have provided. It has to make sense, that's all. Oh, and a quick note on material participation. All the work that you did to get the asset ready for the short-term rental business does not count towards material participation because the asset can't be placed into service until it's done. Taking pictures, interacting with the Airbnb app, and all other managerial duties once the asset has been placed into service do count, so track your time and hours closely. Remember the regular investor that I keep speaking of? Well, check your leases. If you have some non-passive income that you want to offset and have a long-term tenant lease expiring towards the end of the year, you may not want to renew them. This way you can purchase a cost segregation study and give the short-term rental business a chance utilizing a smaller trial window spanning 2 tax years and implementing the tactics I just described. The same logic can be applied to purchasing a new property. Purchasing in the fall and closing late fall allows that same smaller trial window while still satisfying profit motive and intent. It's pretty important to stay away from the scammers and social media, so-called tax celebrities, who are basically just one-trick con artists. They advertise strategies like setting up a short-term rental in December, using Section 179 for the biggest deduction, and put a long-term tenant in on the first day of January. If anyone ever asked them about recapture, they advise you to not dispose of the asset and treat the long-term rental income as if you were still involved in the short-term rental business. Tactics like blacking out dates on Airbnb, putting really high prices so nobody books, and other ridiculous ideas. Some are even brazen enough to suggest that you can have a property manager and that the property can also be out of state because the construction and setup of the Airbnb will take more hours than the work a property manager would do. Some even say to just pay your property manager from another business or in cash or personal check. Some even say that you can offset a $1 million salary if you purchase a $5 million property. But what they fail to tell you is that there is something called an excess business loss limitation, and it's $279,000 for single taxpayers and $578,000 for married filing joint. So there is no way to get a $1 million deduction on a $5 million home. Some even say that if you ever have issues with recapture, then just do a 1031 and move on like a boss. Well, remember that we created 1245 property with our cost segregation study, and doing a like-kind exchange on 1245 property associated to 1250 property is technically possible, but it's super hard. You would have to find another building with identical 1245 components, and that's just not going to happen. So I hope you learned something from this video and are now equipped to better deal with scammers, accountants, cost segregation companies, and tax advisors. Please share my video with a professional that you trust the most, and I'm sure if this person knows his or her stuff, that they will agree with everything I discussed. Please like and subscribe and turn on notifications if you want more next level tax and money saving gems.